I bet you didn't realise that there is a mortgage bailout of sorts buried on page 49 of the autumn statement. If you pay taxes to this government, you will be very interested in the contents of this video, particularly given that income tax, national insurance and VAT together with indirect taxes make up 3/4 of the government's revenue. So welcome back, but if you are new to my channel, I'm a barrister who helps you understand law. So I'd be really grateful if you hit that like button and subscribe and turn on the bell notifications at some point during this video. So given that the autumn statement is 70 pages long and it doesn't detail absolutely everything about how these things are going to be implemented, I bet most of you haven't read it. But I've read this document, and I've read little bits of it that I'd like to bring to your attention because I bet you didn't realise what they were. This one in particular I describe as a mortgage bailout of sorts, which is ultimately funded by the taxpayer, because that's where the majority of the government revenue comes from. So I'm talking about paragraph 516 on page 49 of this autumn statement, which I will link in the description below. This I'm talking about the reforming of support for mortgage interest. So before we get too far into it, what is support for mortgage interest? Well, it started out as a benefit, but then it was converted into a loan of sorts, which is backed by the government and secured on your property in 2018. Essentially, if you are on one of the qualifying benefits, such as income support, income-based job seekers allowance, universal credit or pension credit, you can apply for a support for mortgage interest loan. And essentially what this is a loan to help you pay the interest against the mortgage on your property, or against a loan that you've taken out for certain repairs and improvements on your home. It's paid out as a loan and attracts interest, and you must repay this if you sell your home or you transfer ownership of your home, unless you're moving the loan to another property. And just as a brief interlude, this breaks the #1 golden rule of finance in my view, which is never ever borrow money to repay borrowed money, or the interest on borrowed money. Because all that's going to do is add on to the amount owed. In other words, the mortgage will be the mortgage plus the loan secured against the property. It's just tagging on more and more and more interest and loans and finance and charges and so on and so forth. And eventually that is just going to come back and bite you, because if you do that, ultimately you'll lose the property. So if you're in this position, please don't borrow money to repay borrowed money. Find other ways of saving money, other ways of cutting costs. If you follow my Black Belt Secrets channel, linked in every single video, I will do my best to help you to save money and to regain control of your finances. I say this from a perspective of having done this for many, many years. I will do my best to help you. So back to the video. So now you know broadly what this is, let's look at how it's changing according to the autumn statement. Paragraph 516 states, to support mortgage borrowers with rising interest rates, the government will allow those on universal credit to apply for a loan to help with interest payments after 3 months instead of 9. In other words, as it is now and until the change is implemented with respect to universal credit, you might be eligible if you've been on universal credit for 9 months in a row, as long as you don't get any other certain type of income. This change is lowering that 9-month threshold to just 3 months. So if someone has been on universal credit for just 3 months, they will be eligible to apply for this loan. It goes on to say the government will also abolish the zero earnings rule to allow claimants to continue receiving support while in work and on universal credit. And this will come into effect in spring 2023. So the key wording there is the zero earnings rule. So in order to understand this, you need to look at what the zero earnings rule is. The zero earnings rule is as follows. A universal credit claimant will not qualify for help with the interest payments if they or their partner have any earned income. So again, as it is now and until this change is implemented, if someone is on universal credit but they have any earned income, they are not eligible to apply for this help with interest payments. So although it's not clear how this is going to be implemented, the gist of it is as follows. If someone is eligible for this help because they've been on universal credits for 3 months, regardless of whether they have any earned income, they will still be able to apply for this loan, which will help with arrears and interest payments against the mortgage and certain loans for repairs and so on. And they won't be forced to sell their home, but they will have to repay it if they sell their home, but they might be able to move it to another property. So ultimately, what this is, in my view, is a propping up of the housing market. Because it seems to me that the government realises that lots of people might be falling into arrears with the rising interest rates, unable to repay their mortgage, and repossessions would obviously go up. The house would be repossessed and they'd be evicted from their property. But if now they can still earn money and take this loan out to pay the arrears and the interest against the loan on their property, the mortgage on their property, then that's going to reduce the number of repossessions and therefore propping up the housing market. Now, of course, with things like this, there are always pros and cons. One of the cons being it's going to make it, in my view, more difficult for first-time buyers to get on the property ladder, because one of the ways new buyers get on the property ladder is when other people are forced to sell their home because they can't keep up the repayments. But now, obviously, if they are able to take out a loan to fund the arrears and the interest on the repayments, then that's going to cut out that opportunity for first-time buyers. But it also goes to show that the government has acknowledged the risk of the increase in repossessions due to rising mortgage rates. And repossessions, of course, not always, but very often will result in a crash of the price of that property, because they are very often sold below their real market value in order to realise the loan held against it by the mortgage lender. So as I say, there are a number of different ways of looking at this. It's good news for some and frustrating news for others. Those that are in difficulty repaying their mortgage obviously will get the assistance in repaying arrears and interest on the mortgage, but those that are not in that position and are having an increase in income tax and so on and so forth, they may very well feel that they are funding, through an increase in taxes, a bailout for those that can't afford to keep up the repayments with their mortgage. So ultimately, I thought this was something worth bringing to your attention for discussion in the comment section below. Because, as I said, it was buried in the statement. It's not clear how this is going to be implemented. The only thing that is clear is that the threshold is being moved forward, both in terms of 9 months down to 3 months, and the zero earnings rule is being abolished. So people can still earn money and still get this government-backed loan against the property for pay for arrears and interest against the mortgage and certain other types of loan for home improvements. But of course, I'm sure it goes without saying that many people who are not on universal credits and don't get any of the qualifying benefits to be able to apply for this loan will also be suffering with the rising interest rates and also struggling to repay their mortgages. But because they won't qualify for those benefits, they won't be in a position to be able to apply for these loans, but instead, through an increase in income taxes, will be indirectly or directly, however you look at it, funding the assistance for those that are. So there it is. There's a broad overview of something that I consider to be fairly important that was somewhat buried and somewhat unclear. Let me know in the comment section what you think, what your thoughts are, which side of the fence you fall, whether you're happy about it, whether you're unhappy about it. But in the meantime, I'd be really grateful if you like this video and subscribe, because there's a lot more to dig into in this autumn statement if you'd like me to give you some views on it. And as always, this is not legal advice and it's not financial advice, although I am a qualified mortgage advisor and I've been fairly heavily involved in the property market for many years, and I advise very large clients in the property market, so I do understand this market fairly well. So in the meantime, thank you for watching.